Rachel, hey, welcome back to another wonderful class together for Principles of Accounting 1. Today is the 27th of January, and as you know, we were supposed to be on campus today, face to face, and I was really looking forward to that, but Mother Nature had other plans for us, and Mother Nature said, yeah, no, y'all, you're going to be me online. So it is what it is. But I appreciate your cooperation, your willingness to pivot when we need to. And I just appreciate all of you and all of your efforts that you're making in the class. So thank you, thank you, thank you to all of you and your efforts that you're making in the class so far. We've made it to week 3 already for our class together. And so just wanted to call your attention to the classroom, let you know what's going on and where we are. So here we are on the home page. We are in week 3. If you would like to follow along with today's PowerPoint presentation, it is in the instructional materials folder, and you'll be able to open up the PowerPoint there. And also for this week, we have uh, for our exercises, our usual exercises, we have Excel and we have our Fibrous Cookie Company. I know that this doesn't always work the way that it's supposed to, but like, once again, these are just there for your for your practice. These are not graded, but they are, I think, in my opinion, very valuable hands-on learning experience. So again, optional, nothing's graded, but it's really great to be able to practice this way. So I encourage you to work through it and just kind of see how things go. If it doesn't work for whatever reason, that's okay because once again, it's not graded, but it's just really great for you to be able to practice with these exercises. The What you have to do for this week is we have a chapter 3 quiz related to the lecture that we are about to cover. And then, of course, the past 2 weeks you had a quiz that accompanied each week. So just make sure that we are doing our best to stay on top of our work. That's why we have that class time on Thursday reserved for you to do the work for that respective week. So please make sure that you are doing that. And it definitely does help, especially when it comes to your time management. Yeah, super, super important. So, and then, of course, if you ever have any questions about anything related to your homework assignments, which are the quizzes or exercises or anything at all related to the class or maybe even about the university or about anything really, you could always feel free to reach out to me. As you know, I'm very responsive by email, but you could also give me a call. You can text me. I know that some of you have done that. Yeah, no worries. Anytime you need to get a hold of me, I'm here for you. So, without further ado, let's go ahead and jump into today's discussion on adjusting entries, which is what Chapter 3 is all about. And I'm going to give you some great examples from my experience with these. And I'll also talk about some really great examples that I have for you. And this is something that is really important to understand because in accounting, we really have one or two methods of accounting. Some businesses, especially smaller businesses, they use what we call cash-based accounting. With cash-based accounting, they record their revenue or sales and their expenses when the cash is either received or paid. That's a really easy way of doing things is cash-based accounting because there's no accruals, there's no deferrals, nothing like that. It's very easy, cash-based accounting. But I will tell you that the majority of businesses do not use cash-based accounting. They use accrual-based accounting. And the reason for that is because the IRS, Internal Revenue Service, all those fun people down there that we all have to deal with, especially soon, because I think tax day is in April, um, they require that businesses report using accrual-based accounting. Okay, so that's why it's important that we know and understand how to use accrual-based accounting. Now, in this chapter, I'm going to show you how we do adjusting entries at the end of each month for our accrual-based accounting system. And that's what this chapter is really all about. So we'll walk through, accrual-based accounting from the perspective of how we defer expenses and revenue and how we accrue expenses and revenue. And then after we've made all of our adjusting entries, I'll show you how we prepare the adjusted trial balance based off of our unadjusted balances. Then we make the adjusting entries, and then we have our adjusted trial balances. And then from there, I'll show you how the financial statements are made. So really what this chapter is doing is we're closing out the accounting cycle, more or less, which we're going to learn more about next week. So as we talk about accrual-based accounting, it's important that we understand how accounting periods work. Now, accounting periods are just simply dates. We assume that the company operates monthly. We can report quarterly, semi-annually, and or annually. Okay? Now, I want you to think about the way that the income statement works. Every single month, I make sales and I have operating expenses that I need to record. Right? So here we are. Today's January 27th. We're almost at the end of January 2026. Now, for my business, throughout the month, I've been recording my sales and I've been recording my expenses. Right? That's the way you should do it. You really should be keeping up with your business as you're making your transactions, so that way you don't lose track, right? Now, what happens at the end of January? Well, at the end of January, I need to make adjusting entries for things that have happened throughout the month based off of things that have happened prior in the prior month, right, in December 2025. So I'll give you an example. I typically prepay my insurance for an entire year, right, in advance. And I usually do that January 1 of every year. I prepay my insurance. There's a couple of reasons why I do that. One is that it's typically a little bit less expensive because they give you a discount when you pay in advance. And the other thing is, once I pay it, I know it's taken care of. Now, here's the thing. Beginning of the year, I debited prepaid insurance for the full amount, let's say $1,200, and I credited cash to show the payment of the insurance for the year. Now, that $1,200 doesn't all get assigned as expense in January because that would throw off my report, right? What I'm going to do at the end of January is I'm going to make an adjusting entry. I'm going to debit insurance expense $100 and credit prepaid insurance $100. What that's doing is it's recognizing that I've consumed insurance for the month of January. And I make that same adjusting entry at the end of each month for the year. Right? That's why it's really important that we need to recognize revenue and expenses when they were incurred, because it shows us a more accurate picture of what actually happened in each month, right? So I report my income statement every single month, and at the beginning of each new month, so the beginning of February, I need to start with zero revenue and zero expenses because it's a brand new month, right? You can't go into the next month already having sales and expenses recorded because they didn't happen yet. So at the end of each month, I need to make what we call closing entries as well. Don't have to worry so much about closing entries, this week. We will talk about those next week, though. So for my income statement, I report that monthly. I will also look at that quarterly, semi-annually, and of course, annually. For the balance sheet, I can look at it whenever. The nice thing about a balance sheet is it shows you your balances whenever you feel the need to look at it. But I always report my balance sheet monthly, quarterly, semi-annually, and annually because maybe my investors want to take a look, see how I'm doing. If I'm a publicly traded company, I have to report it quarterly, semi-annually, and annually. For the statement of cash flow, statement of retained earnings, I also do that monthly, quarterly, semi-annually, and annually. It's a good way for us as managers to be able to make decisions and look at our financial statements to make those decisions. And it's also a great way for our investors and other stakeholders to look at the company from that perspective as well. So that's why the period, the amount of time, is very, very important when it comes to reporting our financial statements. I had mentioned earlier that companies will either use accrual or cash-based accounting. Now, smaller businesses, they do use cash-based accounting. They record their sales and expenses when cash is either received or paid. Very, very simple. But again, what I had mentioned earlier is that all businesses have to report to the Internal Revenue Service based off the accrual-based system. So in reality, the accrual-based system provides a more accurate picture of the company's performance. With accrual-based accounting, we record the sales, revenue, and expenses when they were incurred. I record my sales when I have delivered the good or the service to the customer. That's when you recognize that a sale has been made. If the customer pays you in advance of delivering the good or the service, we call that unearned revenue, which is a liability, as you may recall from last week. So we record the sale when the product or the service has been delivered, not necessarily when we have received cash. Okay. So we recognize the sale when the good or the service has been delivered, not when we have received the cash. Because oftentimes a customer might pay us 30 days later. So let's say I made a sale on January 27th. That's great. I'm going to record that sale when I ship the product to the customer. Okay, which will be tomorrow, January 28th. I'll record that as being a sale. Because once it's out of my possession, it's technically been delivered to the customer, and therefore it's a sale. The customer is not going to pay me until the end of February. Based off of the accrual-based accounting system, I need to record that sale in January because that's when the sale was actually made. Because I delivered the goods or the service to the customer at that time. So I'm going to make the sale for January. For expenses, I'm going to give you a classic example. At the end of this month, I'm going to receive my Pepco bill for the month of January. Okay, I'll receive the bill. I'm not going to pay that bill until the middle of February because that's when it's due. But I'm going to receive the bill this month for the month of January. I need to record that electric expense in January, not in February. The reason being is because I actually incurred the electric expense in the month of January. Okay, that's how accrual-based accounting works. The majority of businesses follow accrual-based accounting. for two reasons. One, tax reporting is done in accrual based. And two, it provides a more accurate picture of your company. I'm going to show you this example, which I love this example because it's very accurate. I'm going to show you the difference between accrual-based accounting and cash-based accounting using this insurance example. So I prepaid my insurance, right? I told you that I do that for my business. I do that annually. Some businesses, depending on the policy, might be 2 years, might be 3 years, depending, whatever the policy is that you sign. So here we have an example where the company has a 24-month or 2-year policy that begins December 1st, 2027. So it's beginning at the last month of the year. Based off of the accrual-based accounting system, the first journal entry I'm going to make is the payment of the insurance. I'm going to debit on December 1, 2027. I'm going to debit prepaid insurance for $2,400. I'm going to credit cash. At the end of each month, for 24 months, I'm going to make an adjusting journal entry to recognize the fact that I have incurred the insurance expense. So I'm going to debit on December 31, 2027. I'm going to debit insurance expense and credit prepaid insurance. What this does is it recognizes that we have incurred the insurance expense. I'm going to make that same exact journal entry at the end of every single month for 24 months. This recognizes that the prepaid insurance amount is being used. Does that make sense? Are there any questions about that? So make sure we're clear on this concept. Vanessa, we good?
Yes, I was just going to agree that it does make sense.
Cool. Great. Thank you so much. Excellent. So that's the accrual-based accounting system. The cash-based accounting system, on the other hand, recognizes revenue and expenses when cash is either received or paid. So since I paid December 1, 2027, if I'm using the cash-based system, I would debit insurance expense December 1, 2027 and credit cash. Now, what that does is that it puts all of the insurance expense in the month of December 2027. Now, if you were to compare the two systems, looking back, you compare the two systems, you can see that accrual-based accounting provides a more accurate picture of the expenses as they are actually happening. If I looked at the income statement for 2027 December, I would see this huge insurance expense for the cash-based system, and then every other month after zero. That's not exactly an accurate picture of what's actually going on. So that's why the accrual-based accounting system is more accurate. And based off of that accrual-based accounting system, we recognize our revenue, our sales, when the good or the service has been delivered to the customer. Otherwise, it's called unearned revenue. If the customer pays me before I deliver the good or the service, it's called unearned revenue. When I deliver the good or the service, it becomes revenue. So let's say I sold a pair of sneakers to Dario for $100. Okay. Sold a pair of sneakers to Dario for $100. Dario paid me before I shipped him the sneakers. Okay. Very nice of Dario, but at the same time, I didn't ship the sneakers yet. He paid me in advance. Then I shipped the sneakers a couple days later. So when Dario first paid me, I debit cash for the $100 and I credit unearned revenue for the $100. When I ship the pair of sneakers, right? When I ship the pair of sneakers to Dario, it then becomes revenue. So on the day that I ship the sneakers to Dario, I'm going to debit unearned revenue, $100, and I'm going to credit revenue, $100. Yes, always sneakers. When it comes to our expenses, we recognize the expense when it is incurred, when it actually happens. Okay. That's when we recognize the expense. That's not the same as when we pay it. For example, I expect to receive my Pepco bill January 31, okay, for the month of January. Or maybe I'll receive it, first week of February. But it's either way, it's for the month of January's electric. So I'm going to date that electric bill January 31, okay, for the $360 is probably what it's going to be. So, the way I'm going to make that journal entry is January 30. I'll date it January 31, even though I received the bill probably 5th of February. I'm going to debit utilities expense January 31 and credit accounts payable. Okay, because I received the bill, haven't paid it yet. I'm recognizing the fact that that electric was consumed in the month of January. That's why the date matters, right? So that we're going to record that journal entry in the month of January because that's when we use the electric. It matches the benefit of the revenue that we received in the month of January. You see what I'm saying? So that's where the matching principle comes into play. At the end of every month, I'm usually making some kind of adjusting entry based off of what's happening, right? So adjusting entries we make at the end of each month, and this is to reflect what has occurred but has not yet been recorded. All right. Uh, my favorite example is the deferred expense or the accrued expense. For a deferred expense, this is something that occurred throughout the month, an expense that I incurred throughout the month, but I haven't recorded it yet. My favorite example is, of course, the insurance. I'm going to go through a couple of different examples with you. But there's 4 reasons why I make adjusting entries. One's to defer expenses, the other's to defer revenue based off. The next is accrued expenses and then accrued revenue. I'm going to go through examples for each of these for you. So first, let's take a look at those deferred expenses. As I'd mentioned, my favorite is prepaid insurance. You could also in this example we could use prepaid rent or supplies. Some businesses they'll prepay their rent for like a full year, based off of an agreement with the landlord. That's totally normal. Or another example of this would be what do you call it? Security deposit. Let's say you're renting a facility. Part of that rental agreement is that you have to have a security deposit. We recognize that as a prepayment. Yeah. And then it usually gets used for the last month of rent for that lease agreement. So that's another classic example. So we, at the end of each month, we recognize the consumption or use of that expense. And so the example I love to give is the prepaid insurance. I debit prepaid insurance the 2,400 bucks, credit cash on December 1 to show that I prepaid my insurance for 2 years. At the end of each month, I debit insurance expense $100 and I credit prepaid insurance $100 to recognize the expense as being incurred. So the first step in the process, we recognize the prepayment. So we debit prepaid insurance, credit cash, December 1, 2027, covers 2 years of insurance premium. The second step is we recognize that we have consumed or recognize the expense. And so December 31, 2027, I'm going to debit insurance expense and credit prepaid insurance. What this does is it recognizes that we have incurred that expense. And so that's the adjusting entry that we make. And as you can see, once we've made that adjusting entry, it updates on our balance sheet the prepaid insurance amount down to $2,300 because that's what's left in that account. And we see the increase on our income statement for that $100 of insurance expense. I make the same exact journal entry every single month for that 24-month period. And so what's happening here is I'm recognizing the consumption of that prepaid insurance. Now, at the end of the 24th month, my prepaid insurance balance should be zero. So that's how that process works. Another example of this type of expense is supplies. Let's say you're a chef. Okay. Let's say you're a chef named Kevin, and Kevin has a lot of expenses related to his catering business, right? I know you do, Kevin. So let's say Kevin has things like parchment paper, foil, aluminum pans, baking sheets. I'm sure there's more supplies than that, Kevin, right? But just kind of list off a couple of different supplies that Kevin has for his business. So the way that this will work is that Kevin purchases his supplies through his vendor. Let's say it's Cisco or whoever, Elsco, Cisco, one of those big, those big vendors. So purchases his supplies, probably Costco, but and that's good too. I'm not knocking Costco. I think they got great prices. But okay, so let's say Kevin purchased his insurance, his supplies through his vendor. Okay, so so here's how it works. He purchased, let's say, all of the above: some parchment paper, some foil, some aluminum pans, etc., from his vendor for 9,720 bucks. Okay, the idea is that this will cover some time, right? Maybe half a year worth of supplies, who knows? So we made the purchases in December. And then throughout the month of December, we start using those supplies. So we need to make an adjusting entry for the use of those supplies. So we estimated that we used about $1,050 worth of supplies during the month of December. So we need to make an adjusting entry to recognize the use of those supplies. So we're going to debit supplies expense $1,050, and we're going to credit supplies $1,050. What that does is it updates your supplies balance on your balance sheet, which you know is an asset, and it increases your supplies expense for the month. That recognizes the use of that supplies for the month of December. And this is what that usage looks like, right? So we make these types of adjusting entries for a lot of different reasons, as I mentioned, and we just walk through deferred expenses. A couple of examples there. Uh, the next thing I need to talk to you about very briefly, because this is also important, is this concept called depreciation. Uh, Things like equipment and buildings or anything mechanical can and will break down over time. That's natural. Okay, it's natural for a building to lose its usefulness over time. Even though we maintain it, it still loses its usefulness over time. Just that's normal. Okay, the same with equipment. The same with a vehicle. You purchased your vehicle knowing the fact that every single year it loses value, it loses its usefulness. Why? Because you're using it, right? You're using it for its utility. Super normal, right? Buildings, machinery, vehicles, equipment, all of these things lose usefulness over time. Okay, because they break down, because they wear out, because they get older and they're no longer as useful as they once were. We call that recognition of the loss of its usefulness. We call that depreciation. Okay. Anything can and will break down that it's mechanical. So the only fixed asset we do not depreciate is land. We never depreciate the physical dirt, the land that the building sits on. Why? Because land is infinite. I could always knock the building down and replace it, right? The land's still going to be there. So we never depreciate land for that reason. We do, however, depreciate buildings, machinery, vehicles, and other equipment. So the way that we do that, and this is one of a few ways we do that through what we call the straight line depreciation method. What this method does is it depreciates the value of the asset over its useful life. Okay. I'm going to give you a classic example of this. Uh, we purchased a vehicle for 26,000 bucks. According to the IRS, they say that that vehicle is going to be worth about, that vehicle will last about 5 years. Okay. The IRS publishes a report every year called the Makers Report, MACRS report. And they kind of give us, that gives us, that kind of gives us, what do you call, an estimate of how long things should last. Take it for what it's worth. We know that machinery and buildings, all it's going to last longer than 5 years. I know that a car is going to last longer than 5 years. IRS says it'll last for 5 years. Okay. So the way it works is I'm going to take the vehicle's cost, 26,000, minus its salvage value. Salvage value is what it's worth at the end of its useful life. It's what I could get the scrap metal for, it's what I can sell it for at the end of its useful life, whatever. We call that salvage value or scrap value. So take the 26,000 minus the $8,000 salvage value, then I divide that amount, which is 18,000, divided by 5 years. Okay, we call that, and that amount at the end of each year, I'm going to record the depreciation expense by debiting depreciation expense and crediting accumulated depreciation. I'm going to walk you through the steps, but I just wanted to give you an example of how that depreciation works and why we do it. It's because things lose their usefulness over time. We need to recognize the loss of that usefulness. So we expense it out. So looking at our example, yeah, of course. Yeah, you definitely go back and watch again. Sorry, Star. Uh, and then of course, Star, if you have any questions, just feel free to ask. Happy to help. Uh, for the depreciation, looking at the example. So we purchased a vehicle December 1 for 26,000. Useful life of 5 years, according to the IRS schedule. Has a salvage value or scrap value of $8,000. Uh, it's expected to last for 5 years. So I need to record the depreciation expense using the straight line depreciation method. Now, here's the thing. Because I bought this vehicle during the year, I need to recognize the depreciation expense for the month of December, since December is the last month of the year. So instead of dividing by 5, which would be the amount per year, I'm going to divide by 60 months, which is, 60 months is 5 years. What that does is it gives me a depreciation expense monthly. And at the end of December, I'm going to debit depreciation expense and credit accumulated depreciation for the amount for that month. Then for the next subsequent 4 years or 5 years, I'm going to do it annually. But I'll show you what it looks like just to keep things easy for us. So the first step, we identify the original cost, and then we subtract the salvage value or the scrap value. So in this case, original cost 26,000 minus salvage value of 8,000, giving us a total depreciable cost of 18,000. I'm going to then take that 18,000 and divide by 60 months or 5 years. 18,000 divided by 60 months means my depreciation expense per month is going to be $300. So at the end of every single month for 5 years, I'm going to debit depreciation expense and I'm going to credit an account called accumulated depreciation. Accumulated depreciation is called a contra asset account. Contra asset account. On the balance sheet, it's an asset account that accompanies the fixed asset. So I'm going to have an account called equipment, which is a fixed asset account on the balance sheet. And it's going to have a positive balance of $26,000. And it's going to stay that way for 5 years. I'm going to be able to depreciate that using what we call a contra asset account that holds a negative balance on the balance sheet, but it's a contra asset account. So it's going to have a negative balance on the balance sheet, but it's also an asset account. It's going to contra flow with the fixed asset equipment account. That's how that works. So in other words, you're always going to have a balance of equipment of 26,000. Then you're going to have accumulated depreciation for equipment, and that's going to continue to show a negative balance every single month for the next 5 years. So I'm going to debit depreciation expense and credit accumulated depreciation at the end of every single month for a total of 5 years. At the end of year 5, that accumulated depreciation balance on the balance sheet should be 26,000. At which point I could either leave the asset on the, oh, I'm sorry, it'll be 26,000 minus the 8,000. Minus the 8,000 because it's 8,000 is salvage value, remember? So once it reaches that amount, which is 18,000, once accumulated depreciation balance reaches 18,000, I could either sell the asset or keep it on my books and then remove it from my books and continue to use it. I would just need to treat it as an expense moving forward. So on your balance sheet, you're going to see equipment will be 26,000, and then accumulated depreciation is going to go up by $300 every single month for 5 years until it reaches 18,000, at which time we would either then take it off of our books or leave it on, depending on what the business decides to do. That's how depreciation works in a very general sense. I don't want you to worry too much about it right now because we will go deeper on that concept in future weeks. So we talked about deferred expenses, and that's why we brought up depreciation expense um, in that conversation. Next, I'd like to talk about deferral of revenue, which is really all about unearned revenue. Now, as you know, unearned revenue is when a customer pays us in advance of delivering the good or the service. I gave the example of the sneakers with Dario. I was going to sell Dario a pair of sneakers for $100. He paid me before I shipped the sneakers out. It's unearned revenue for me until I ship the sneakers out. Then it becomes revenue. So debit cash $100, credit unearned revenue $100, and then when I ship the pair of sneakers, then I'm going to debit unearned revenue for 100 and credit revenue for 100. So that's how the process works. I'm going to give you this example. So here we have an example where our company provided consulting services to a customer. We contracted with the customer to provide them with 60 days of consulting services starting on December 27th. Okay. Well, since December was last year, I need to recognize revenue from December 27 to December 31, about 5 days. Okay. Because the revenue happened the year before for 5 days. So I need to recognize the revenue for that 5 days in the prior year. Okay. So December 26th, we enter the agreement with the customer. So I debit cash for 3,000 and I credit unearned consulting revenue for 3,000. I need to recognize revenue for 5 days for the end of 2025. So I'm going to figure out what that amount is by taking the 5 days divided by the 60, which is the amount of time. And I'm going to multiply that by the amount we've contracted for, in this case, $3,000. That gives me amount of $250. So I'm going to debit at the end of December, I'm going to debit unearned revenue, $250, and credit revenue, $250. The rest of that revenue, I'm going to recognize in the following year or in this year. So at the end of December, it looks like this. End of December, we made the adjusting entry, debit unearned revenue, credit revenue, $250. The rest of that amount, that $2,750, I'm going to recognize that at the end of the contract, which happens to be in February. Okay. All right. So that's the adjusting entry that I make. That's for uh, the revenue recognition. The next type of journal entry that I like to explain is accrued expenses. Now, accrued expenses, these are expenses that we have incurred, but we had not yet paid them or recorded them. Typical examples of this type of thing would be like wages. My employee worked for the past 2 weeks. I haven't paid them yet. I also haven't recorded that expense yet. but they worked. So I incurred the expense. I haven't paid my employee yet. So I need to record the expense and then I need to pay them. That's a classic example of accrued expense. Other examples would include things like taxes. We incurred the sales tax. We haven't paid the sales tax yet. Interest. We received the interest. I haven't recorded it yet. Or I have the interest I need to pay on a loan. I haven't recorded that interest yet. Rent expense. I was there for the month. I haven't recorded the expense yet. Those types of things. Those are accrued expenses. So I'm going to walk through the most common one, which is wages. My employee worked for the 2 weeks or for the week. I haven't paid them yet. Now, here's why. Here we are at the end of the year. Once again, my employee worked for the 5 days for that week. The year ended on Wednesday. So I need to record the 3 days that my employee worked for the month of December. The other 2 days were in January. Okay, so at the end of December, I need to make journal entry, adjusting entry. I need to debit salaries, expense, and credit wages payable for that 3 days to recognize the expense in the month that it was incurred. So we have the example. My employee earned $70 per day. They work 5 days a week for a total of $350. The year ended on Wednesday. Okay. So I need to incur the wages for the 3 days. So $70 times 3 days. It's 210. At the end of December, I make the adjusting entry. I debit salaries expense 210. I credit salaries payable 210. Now, obviously, my employee worked the other 2 days, but I'm going to record that as a wage expense in the month of January. So my employee worked. I make the adjusting entry end of December for the 210. I owe my employee at this point for the two full weeks. Well, I think more than that. 1,610 is what I incurred. Obviously, I've been paying them along the way. I paid them for the week of 12/12. I paid them for the week of 12/26. I have not yet paid them for the week of 12/31 because 12/31 was in the middle of the week. So now I got to pay them for that 3 days and for the full 7. So I've already accrued the 3 days. I have to accrue the next 2 or the following week, or however that worked. So I would debit my salaries when I get ready to pay my employee on July 9, or I'm sorry, January 9, for the 3 days plus the 2 plus the 5, because I remember I pay my employees every 2 weeks. Debit what salaries payable for the 3 days, 210. Debit salaries expense, 490 for the full week thereafter, plus the 2 days. And I credit cash, 700. That's how we work with accrued expenses. The other one that you need to know about is accrued revenue. Accrued revenue, this is when we have, how do I want to say this? We have earned the revenue, but we have not yet recorded the revenue, and the customer has not yet paid us. Okay, that's what we call accrued revenue. This is very typical when we make an agreement with a customer, the customer is going to pay us later. We've worked on the customer contract for a couple days. We need to record that revenue for those days that we worked. So here we have an example. 12/12, we entered an agreement with a customer for $2,700 was the contract over 30 days. So we need to recognize the revenue that occurred between 12/12 and 12/31. So that way we could recognize the revenue for the month of December. So the way we figure out how much that is, 12/12 to 12/31 is 20 days. So I take the amount of the contract, $2,700. I multiply that by 20 over 30, which is the amount of time that has passed. And that gives me $1,800. So I need to debit accounts receivable, $1,800, and credit consulting revenue, $1,800. Now for the remaining balance, of course, I'm going to recognize that as revenue in the month of January for the remaining 10 days. This is what your balance sheet is going to show you is $1,800 on account receivable, and your income statement for the month of December is going to show us the running revenue that we've earned in the month of December, including the adjustment. Now, at the end of that 30-day contract, the customer is then going to pay us the full $2,700. So we're going to debit cash $2,700, credit the receivable for the $1,800 that we accrued back in December, and then the remaining balance, consulting revenue, $900. So that's how we recognize when the customer actually pays. So you saw that all those different types of adjustments that we made. Well, I'm sorry. I must have knocked the cord out. Sorry about that. Y'all can still hear me, right?
Yes, Professor.
Great.
Yes, Professor.
Thank you. Thank you so much. Yeah, sorry about that. I accidentally hit my microphone a little too hard. So I just showed you how to work through 4 different types of adjusting entries: deferral of expense, deferral of revenue, accrued expense, and accrued revenue. Why we do them, what the impact is, and what this slide shows you is how it all links back to the financial statement. Sorry about that. Okay. So now I'd like to show you how all those adjusting entries that we made affect the financial statements. We first prepare what we call an adjusted trial balance. Now, the adjusted trial balance stems from our unadjusted balances for all of our accounts. The first thing we do is we list out all of our accounts in order. We start with all of our balance sheet accounts, starting with assets and then liabilities and then equity accounts. And then we list out all of our income statement accounts, all of our revenue and expense accounts. That's the first thing we do is list out all of our account names. The next part is we identify their balances. Now, of course, I get the unadjusted balances based off of the balance sheet before we make the journal entries. Before we make the adjusting entries. And the same with our income statement before we make the adjusting entries. Now, at the end of the year, we make all of our adjusting entries for those 4 reasons we talked about. Accrued or deferred revenue, accrued or deferred expenses. So we make our adjusting entries. This middle column here that says adjustments This stems from all of those adjusting entries that we made. The little letters next to them, those tie back to the exact entries that we made earlier. Now, I need to be able to find my adjusted balances. That stems from the difference from the unadjusted trial balance based off of the adjusted amounts. So, as you can see, from reading from left to right, some accounts were not adjusted at all, like we didn't adjust anything with cash, but we've adjusted a lot of our usual accrual-based accounts. We made an adjustment to accounts receivable, supplies, prepaid insurance. We did our depreciation, salaries payable, unearned consulting revenue, depreciation expense, salaries expense, insurance expense, supplies expense. So we worked through A, B, C, D, E, F. We worked through 6 different examples represented by letters A through F. And we can then see, based off of those adjustments that we made, the effect on the respective balances. So here we are, end of the year. On the right-hand side, we have our adjusted balances based off of our adjusting entries. And that is what's reflected on our final balance sheet and final income statement for the year. That's how to read an adjusted trial balance. Now, how do we prepare the adjusted trial balance? There's 4 steps that we need to follow. The first step is we prepare the income statement using revenue and expenses from the adjusted trial balance. I'm sorry, this is how we prepare our financial statements. That's what I meant to say. We prepare our income statement based off the adjusted trial balance. That's the first thing we do. The second thing we do is we prepare the statement of owner's equity based off of changes in withdrawals and anything else, net income. The third step is we prepare the balance sheet based off of the adjusted balances. And the fourth thing we do is we prepare the statement of cash flows based off of changes in operating, investing, and financing activities. So this slide here shows us, based off of those 4 steps, exactly how the income statement, balance sheet, and statement of cash flows and statement of retained earnings are all created based off of the balances from our adjusted trial balance. And that's how we prepare our financial statements for the end of each year. One of the last things that we do as managers, especially as managers, after we've prepared our financial statements, is we like to use ratios to really understand the overall company's financial health. And one of my favorite ratios that I love computing is called profit margin. I love profit margin because this does a really good job of measuring each dollar or percentage of profit based off of each sales dollar. Okay, so what percentage of our sales is profit, right? The way that we calculate that is we take our net income found on our income statement divided by our net sales or net revenue. And what that'll do is it'll give us a percentage. And that percentage is what we call our profit margin. So what percentage of each sales dollar is profit is what the profit margin tells us. Now, as you can see here, we're looking at Visa and MasterCard from the most recent year. And yeah, these numbers are pretty accurate. Um, so we can see that Visa and MasterCard have 53% profit and 45% profit margins respectively, which is pretty good. But you know that those companies they're primarily service-based companies. They don't have a whole lot of overhead, so their margins are always pretty good. I like this calculation because before, for me as an investor, before I look at investing in any company, the first thing I love to do is calculate this profit margin because it tells me about the company's ability to generate profit, right? And the higher, the better, obviously. And the way I consider a company to be a good investment, I look at anything 30% and above. If it's 30% or higher, it's usually a good investment for me. It demonstrates good future growth. Uh, do I want to walk through this with you? Yeah, I might as well. Just want to quickly show you with those prepaids. And I showed you, this is really showing us the difference between cash-based accounting and our accrual-based accounting. So on the top is really based off of your cash-based accounting. On the right side there, just debiting the insurance expense, crediting cash. On the left side, on the top, we have the prepaid insurance. Uh, we debit prepaid insurance, credit the cash. At the end of each month, we make the adjusting entries, and we can see the effect on the balances. This is kind of what this shows you from a, I don't know, nice little picture, if you will. And this is the effect on the balances. So take it for what it's worth. And then I can also show you the effect uh, cash-based accounting versus accrual-based accounting, the effects on revenues. So for cash-based accounting, we recognize revenue when we receive the cash. For accrual-based accounting, we recognize the revenue when the good or the service has been delivered. And we make the adjusting entries at the end of each month accordingly. Those are the effect on the balances. Okay, so this brings us to the end of our discussion today on adjusting entries. Now, of course, before we wrap it up, I just wanted to see if there are any questions at all on this topic that any of you have, any burning questions about the course, anything at all. Please ask. Yep.
Professor,
Yep.
would this recording be up? Because I think the last week recording wasn't up, or I didn't see it. But would this
Oh,
recording be up so we can review it?
yes, absolutely. I'll post this recording along with the last one as well to the classroom. So I apologize for that. I thought I did, but I'm sorry about that. Yeah, I'll make sure that this one gets posted to the classroom this evening.
Okay, no problem.
Yeah, great. Questions, comments, concerns?
I have a question,
Dario,
Professor.
please.
So going back to the sneaker thing,
Yeah.
when you already put down that you gain money, but not like actually, what happens if somebody refunds it or you know?
Yes. No, great question. So that's why we recognize unearned revenue as being a liability account. So, uh, so let me walk through that transaction with you one more time, just so everyone's on the same page. So, with unearned revenue, so the way the sneaker example, $100, okay? So, so the way it works is that let's say I sell Dario the pair of sneakers for $100, but I say, hey, I need you to pay me before I can, I don't know, ship the product out to you. All right. So let's say here we are 120. I made the sale. Okay. So Dario pays me in cash for $100. So I'm going to debit cash $100. And then I'm going to credit unearned revenue for the $100. So then a few days later, because there was a snowstorm, I was unable to send out Dario's sneakers. I just happened to ship them today. So on 127, I need to debit unearned revenue for the $100. And then, so I don't want to hit enter because I'm going to credit revenue for the $100. Now, what that does is now let's say to Dario's point, let's say Dario calls me up and says, "Hey, Dr. B, never mind on that sneaker order. I need to cancel it." So obviously, I'm going to refund Dario. So the way that would work, so let's say cancel order. Let's say Dario cancels on a 124. Okay. So cancel on 124. And so what I'm going to do there is obviously I need to pay Dario back. And I need to reduce the unearned revenue because it's no longer anything. So what I would do in that case is I would debit unearned revenue, the $100, and I would credit cash, the $100, to show the repayment. But that's the type of entry we would make if the customer canceled for whatever reason in between the order and me shipping the product. Now, if the customer returned the product after the fact, then I would have to reverse both the revenue transaction and the cash transaction. That's an excellent question. I hope that helps to answer it.
Yes, it does.
Great. Any other burning questions? Anything at all? Okay, great.
Will we have online class next week or will it be?
Yes. Yep, we're gonna follow our schedule as planned. So next week we'll be once again on Zoom. Us, God willing. Well, next week we'll be back on Zoom on Tuesday, the February 3rd. Then on February 10th, we should be meeting in person, barring any type of natural disaster any time between now and then. So yeah, to answer your question, Diana, so February 3 will be online, and then February 10 will be in person.
I submitted the chapter 2, the work that we had done a little late, but I still wanted to let you know. I didn't know if it had went through on your side that I submitted it.
Yeah, you're good. I
Okay.
saw everything on Blackboard, so you're all set there, Star.
Okay, thank you.
You're very welcome. My pleasure. Any other comments, questions, concerns? Okay, great. If in the meanwhile, if you ever need anything, you already know. You can email me, you can call me, you can set up office hours. We can do whatever. I'll be sure to take care of you, no matter what it is. So once again, I thank all of you for all of your efforts in the class so far. I do sincerely appreciate all of you. And again, if you need anything, just reach out. I'm here for you. And I hope you have a wonderful rest of your night. Thank you all so very much.
Thank you. Have a good night,
Be
Professor.
safe, stay warm. Take
Bye,
care.
Professor.
Thank you so
You
much.
too, Professor.
Thank you,
Thank you.
Professor.
Thank you.